What if I told you that one of the most durable compounding machines in the world doesn't make apps, sell ads, or chase attention? Instead, it builds highways, airports, and power lines. And it just might be one of the smartest long-term holds no one's talking about. We live in a world obsessed with speed, but Ferrovial shows us the quiet strength of patience. While everyone rushes into AI, crypto, and the next tech darling, this infrastructure company has been quietly laying the foundations of modern life. Literally, it's not flashy, but it's reliable, essential, and beautifully positioned for the next 30 years of compounding. Ferrovial is a global infrastructure operator. Its model is vertically integrated. They design, finance, build, and operate toll roads, airports, and energy transmission assets. This gives them deep control over margins, timelines, and value creation. Let's start with toll roads. Under the Sintra brand, Ferrovial owns and operates managed lanes in the U.S., high-margin, congestion-reducing toll roads in Texas, North Carolina, and Virginia. These roads operate under dynamic pricing, which means Ferrovial makes more money as traffic increases. It's a beautiful inflation hedge and a cash cow. For example, the LBJ Express in Dallas is a state-of-the-art managed lane system. It uses real-time sensors to adjust pricing every 5 minutes, balancing congestion and maximizing throughput. Drivers pay to save time, especially during rush hour, and Ferrovial collects tolls with operating margins often above 70%. That kind of profitability is rare in physical infrastructure. Then there's JFK's new Terminal 1. Ferrovial is leading the redevelopment of one of America's busiest international terminals. Once operational, it'll generate recurring, inflation-linked revenues for decades through landing fees, retail leases, and parking charges. This is not just a project, it's an anchor asset. And now, energy. Ferrovial is entering solar PV and electricity transmission, a strategic bet on decarbonization and the global energy transition. In places like Texas and Chile, Ferrovial is building transmission lines to support renewables. While early stage, this division taps into a trillion-dollar market with long-term tailwinds. Financially, they're disciplined. The Del Pino family owns over 20% of the company, ensuring long-term alignment. This isn't some faceless board chasing quarterly bonuses. It's an owner-operator mindset. The balance sheet is strong, with net cash at the parent level, and most debt is non-recourse and tied to individual projects. Over the last few years, Ferrovial has divested lower-return businesses like its services division and rotated capital into higher-return opportunities, such as U.S. concessions and energy. It's not just investing, it's upgrading. Let's talk about the moat. Ferrovial operates literal toll gates. Once you own the only fast lane through Dallas rush hour, it's nearly impossible for a competitor to replicate that position. These assets are backed by 30 to 50-year concession agreements. That's decades of locked-in cash flows. There are also switching costs and regulatory moats. Cities can't just replace Ferrovial with a new contractor overnight. The company's relationships, execution history, and project finance capabilities make it a go-to partner for governments looking to build the future of urban mobility. So what about returns? ROIC at the consolidated level is still below 5%. That's not ideal. But it's heavily depressed by assets under development. When you isolate the projects that are fully operational, the return on incremental invested capital, ROIC, often exceeds 20%. That's where the compounding engine lives. In fact, if you look at toll road revenue alone, it's grown from $439 million in 2020 to $1.26 billion in 2024. That's a KGR of over 30%. And that's before JFK NTO even begins contributing. Energy revenue is growing triple digits year over year. The story here is not just growth, it's maturation. Earnings per share? Distorted by one-time gains like the Heathrow divestment. But adjusted EPS is rising steadily, supported by core EBITDA growth and stable margins. This is a business transitioning from construction-led cycles to recurring cash flow dominance. Let's also touch on capital allocation. Ferrovial has a track record of returning capital when appropriate, via buybacks and dividends. But it's also shown restraint, choosing to reinvest when the IRR is compelling. That's exactly what long-term owners should want. Is the stock cheap? Not really. On normalized free cash flow, it trades at 65x EV/FCF. But high-quality infrastructure rarely trades at deep discounts. The key is that future cash flows are highly visible, long-dated, and inflation-linked. You're paying a premium for durability. Ferrovial isn't for traders. It's for builders. If you're looking for a capital-efficient platform that compounds slowly, safely, and with structural tailwinds behind it, Ferrovial deserves your attention. Boring? Maybe. But boring is where real wealth often hides. Want the full memo? It's at Nora and Bob Compounding at norabob.substack.com. Link below.